All right. Welcome everybody to Midas Investing Live. Been 2 weeks since we had a live show. I hope you guys didn't miss me too much last week. I decided to take a week off. Just kind of came up on the day before that live and realized I didn't really have too much of a plan for it. And was just like, you know what? It's the week before my school starts, so why don't I just take this one off? So we did. Um, Here we are next week. Still have not too much planned for today's show. It's mostly just kind of a bit more relaxed, I guess you could say, and discussing the changes in portfolio over the last few weeks and probably looking at more stuff that you guys suggest, assuming people show up to suggest things, of course. But nonetheless, we can hop over to portfolio a bit. Pavel, hello. We'll also be discussing a few changes to the kind of channel over the near term. In fact, I guess we'll talk about that, I guess, right up front. So over the last year or so, I have been using a service called Restream to broadcast to YouTube and Twitch, and also Facebook and Twitter, because they have a bunch of other options. But primarily, I was really just trying to get on YouTube and Twitch simultaneously. But the point is, I was multicasting to multiple platforms simultaneously. And that service was free when I first started, but then eventually it started costing money if you wanted to include all those locations. And I decided to continue paying for it for 1 year just to see if I could expand on other platforms. But frankly, we've only gained any sort of traction whatsoever on YouTube. So the point is I know every once in a while we do have somebody who tunes in off of from the Twitch chat. So I feel like I gotta kind of make a point of calling it out here on this live stream, that basically after this live stream, I'll probably stop doing the simultaneous restreams to multiple platforms. I'm at least going to go down to the free option that Restream has. They might have still allowed for 2. I can't remember what their current situation was, because I think they were slowly making more of the features on that website cost more over time. So they might still allow for 2. If they do still allow for 2, then maybe I will still do it on Twitch. But the point is I'm not sure which one I'll do it on. Maybe it'll be Twitch, maybe it'll be Twitter, maybe it'll be I don't know, Facebook, I guess, also wasn't really getting too much traction here. None of the others were getting much traction. Frankly, it's only Facebook where we've gotten really any level of subscribers. So the point is that's where all my focus is. And I was kind of willing to kind of throw a little bit of money at that just to see what would happen, and wasn't really getting anywhere with it. So the point is we're not going to throw money at that anymore. There's other things that we've put money towards in our for like tools for the channel or for investing in particular. For example, I have one of the subscription tiers of this website, Ticker, which you guys probably see me use pretty regularly on this website, and I'm actually pretty satisfied with what they offer. It could be better in some ways, and I found other places that offer pretty much similar types of services in terms of like financials and transcripts and other things like that from companies in a screener, things like that. But the point is I'm reasonably satisfied with this website's offering. Whereas the Restream, which was a little bit more focused towards the channel, I wasn't getting too much use out of. But anyway, the point is like I said, if you are one of the like 1 or 2 people who happen to be watching me on a different platform other than YouTube, I may or may not be super available on them in the near future. Like I said, I might juggle a second platform back and forth, but the point is YouTube's the only one that really is gonna for sure see me moving forward. So that out of the way, we can kind of talk about some of the portfolio stuff here. Look right in front of me. We did have started at 4 p.m. sharp. Hey man, I usually do. Maybe I'm a couple minutes late sometimes, but I'm usually kind of sitting here a few minutes before, at least trying to get a few things in order. Good to see you here. It's interesting to see you here more at like 4 p.m. sharp. Usually you show up like an hour late or something like that. What's up with that? Not out in the garden today. But anyway, so over the last 2 weeks, we have had some changes in the portfolio. We've moved in and out of a few positions. Obviously, if you guys have been paying attention to my channel, I did put out my PayPal video last Friday, which I had started a position in PayPal about a week prior to that. So and the point is I have definitely started one position there, and if you haven't checked out that video, I'd highly recommend it. Obviously, it's a It's gotten some views already, so it seems like people have enjoyed it pretty good. But that is one position that we have added to the portfolio, and it's already about kind of halfway up the chain in terms of size, I guess you could say, though it is still only at about 2% of the portfolio. I can see here with the target deviation kind of well above it, we have it currently set to perhaps be up to 4%. But I would also point out that our target deviations do take into account some momentum factors, which isn't really in PayPal's favor. So the point is, if momentum was to turn in PayPal's favor, that 4% would likely turn to an 8%. So 4 to 8% is probably kind of like the target size that I have in mind for PayPal. You can basically kind of assume off of that. Though, like I said, it's currently at 2, moving towards 4. But so beyond that, we also had a little bit of activity in terms of the merger arbitrage targets that we were paying attention to. If you'll pay attention closely here, well, actually I have some of the colors kind of off here. We no longer have a position in BKI, which we got out of, as well as we did eventually take the profits off of Silicon Motion, which was another arbitrage play that we had. Although I think I may have talked about that one in the previous live that I had previously. But the point is, got out of those arbitrage plays. We still have a position in Tower Semiconductors, which unfortunately had some pretty negative news this last week. So you can see we're down pretty significantly on it. And I didn't quite trim it that day because I was kind of hoping for a little bit of a price bounce back on the day after, which it did bounce back a little bit the day after, but it was only like 1 or 2%. So it wasn't really quite significant. And then I almost decided to sell out of it at the end of Friday, but I decided not quite to. Either way, probably selling out of that position in the near future because it did drop down approximately towards where my fair value for it was without a deal in place. So the point is even you could hold it at its current levels, but the point is it was always meant to be a merger arbitrage play. So the point is, I'm not going to allow for mission creep. We're probably going to just get out of that one, which means at that point we would not really have too much of merger arbitrage in the portfolio, other than the few shares that I did pick up way back when of Spirit, which also isn't a super satisfactory one, but honestly doesn't necessarily have the greatest of odds for the merger arbitrage play. But you can see it's also an extremely minuscule amount of our portfolio, so I'm not exactly too concerned about that. But okay, so other things that change in the portfolio. We no longer have a position in Sandfire Resources, our copper mining position that we've held for quite some time. It was overall not a very satisfactory position for us. We had much higher targets for it when we initially invested in it, and then brought those targets down over time while we were investing it, and to the eventual point that it seemed like I had actually just bought it at about fair value. And then the fair value itself didn't really take into account the fact that there was a lot of complications investing in it due to trading fees associated with foreign stocks, as well as low liquidity on that over-the-counter listing. Scott, you want to reduce AAP, that Y target under the line? It is a little bit under the line, but as I was saying a bit earlier, these targets have the momentum factor taken into account into it. And I don't necessarily trim too fast if it's over target. This is more of like a buy up to target, and I'm willing to let things go over target. Like for example, you can see these ones over here, I'm significantly over target on. And like for example, FG, I'm not looking to trim any of that, no matter how much I'm over target on it. I was over target on FNF recently, which I was just about to get to. I have trimmed out of some FNF, and that kind of will explain some of the difference in what would make me trim companies that I'm over target in. FG has a lot more growth, sales growth, like actual revenue growth, top line growth, forward potential, appreciation potential associated with it, whereas FNF is a little bit more cyclical and a little bit more of just like a straight up value play and on any given price level. So the point is I'm much more willing to cut something that's over target like FNF than I am of FG. Now I'd say AAP is a little bit more in the FG kind of camp than it is in the FNF camp. As you know, we've talked about my more bullish cases for AAP involve some pretty high price targets, even though yes, it is still a little bit of a turnaround play. So it's kind of somewhere in between the two. But the point is it would have to be significantly over target for me to really start thinking about it that way. These are kind of just general guidelines. And then, like I said, it has that momentum factor that can double or have the target at any given point. And so I try to take that into account. So for example, if I was to look at AAP, I might go and check to see if it has that momentum factor actually triggered for it, which I'm not sure if it does currently. I could go over here and yeah, we're currently below the 50-day moving average. So it wouldn't be getting a momentum boost. which means that, for example, if it did go above its 50-day moving average, this target would double and suddenly there would actually be a little bit of room to add. But I wouldn't necessarily add if the momentum factor is on either, right? So the point is we're trying to kind of allow for the position to grow without cutting it, which is why the momentum factor is on there. But the target deviations, I don't usually necessarily act on them until it starts to get pretty extreme, the differences in it. And for example, that's one of the reasons I was making a big move on the Sandfire Resources move position, because Sandfire Resources, I was significantly over target. I was way over target. Like, yes, I really wanted my copper exposure. And yes, I didn't think that stock was like crazy overvalued. In fact, I thought it was basically fair value, maybe even slightly undervalued. But I was way over target. Especially considering it's a commodity company, a foreign commodity company, an over-the-counter foreign commodity company. It's like there's a lot of risks there. I don't necessarily want to be way over target for a company like that. So getting to that point, that is part of one of the other moves. Like I said, I got rid of Sandfire Resources, but we did also swap, as I was saying I was likely going to do. I had been talking about this honestly for months, that Freeport-McMoran, FCX, was my preferred target as a company to swap into. I don't think FCX is some amazing deal where it currently stands necessarily. I think it's a little bit undervalued and only a little bit under the median price point. But the point is it at least is not a foreign copper company. Most of their assets, or at least the lion's share of them, are in the United States. They do have some foreign assets, but they have a lot of really high quality assets in good legal jurisdictions like the United States. They have a very clean balance sheet. They have a much larger profile that makes them much more stable of a bet on copper prices themselves, rather than just a bet on the speculative properties that Sandfire has. And so that's why it's like it's a much lower risk position. So I hopped to FCX, and it's much smaller. And so the point is I can slowly add into it if copper starts to have major dips, if we go into a little bit of an economic down swing relatively. So pretty good swap, I think, in terms of making that move. Also did buy a little bit more in mode this week. I should point out in mode did finally come back down below our average price point a little bit, though not below our initial price point. But the point is I see lots of opportunity there, so I'm trying to make sure we're at least have a significant position there. We did add Generac over the last 2 weeks as well. I think I mentioned that in the last live though, but added to it a little bit more over the last 2 weeks since then. I listened to half of that electricity video. Oh yeah, you're talking about the Patrick Boyle one that I posted. I did actually kind of want to mention that here today, because yeah, that video was really good in covering a lot of the details surrounding this kind of theme that I've been talking about a lot of. Obviously I've talked about it a lot, and my next valuation might be possibly related to it as well. We'll get into that as well. But yeah, I will say, well, while we're on the topic, if you guys are watching live or on the replay, please subscribe to the channel. It'd be really appreciated. Please like the stream. Please like the live stream. That way we can track more viewers. And like I said, go watch that PayPal video if you haven't. Watch that, like that, share that if you would as well. But also, if you're watching live or on the replay and if you haven't before, consider joining our free Discord. As we were just talking about, I post things in the free Discord, which is the video I was just talking about. Is this really great? Oh, it's not there. It's the coming announcement. This really great video that Patrick Boyle, another very famous finance YouTuber, posted about the electrify everything theme, which is kind of like the whole theme about making everything part of the electric grid and how that requires massive reinvestments in major sections of the economy. We were just talking a lot about copper, that being a huge factor there. So consider joining the free Discord. Please subscribe to the channel. Please like the video, like the stream, all that jazz. We'll come back over to discuss it. What was that last comment you said? I read the wires use more aluminum now than copper. They do use significant amounts of aluminum. Aluminum is definitely another metal to pay attention to, which I didn't do it on that initial copper commodity run, I think, when we were talking about commodities a few weeks back, but I did add it, I think, after the fact. So I did have some targets for aluminum, but as far as like the macro factors that I found correlated with aluminum, I don't see quite as much upside in it. I think the price is just accelerated upward much more on this. I think a lot of people are just aware much more that aluminum is an issue, whereas copper, there's this kind of like dual issue with it, where copper is in so many different things on such a broad basis that people see it as this kind of leading indicator to the economy, which makes people very hesitant to invest in it when they think the economy is going into a little bit of a tailspin. So I think that's why copper is a little bit more depressed in price, more than aluminum is. But yes, they're both very, very important in terms of that theme. That's definitely true. And there's many other ones too, like nickel is another key factor, another one of them. Like that's one of the ones that Elon Musk is always going on and on and on about for electric vehicles, which I also think nickel is a bit accelerated. Zinc's pretty important. Uranium is kind of on a little bit of a different topic related to it, but still kind of in somewhat of a similar vein where, people are trying to change energy sources and whatnot. But some of these other ones too. You and I were talking the other day about steel. I still haven't done a little bit of a specific analysis of steel versus the iron, but we were already talking about our general bullishness for iron as well. But yeah, the point is the whole commodity space is severely underinvested. That Patrick Boyle video is one video that's talking specifically about the electrification. Well, I would also point out this kind of more specifically natural resource video that I posted as well, where it's much more broadly about natural resource. This rather famous resource investor, Rick Rule, talks about a variety of resources, but in general, they're just massively underinvested over the last 10 to 20 years, partially because they're just not very popular to invest in. So there just hasn't been as much capital there, as well as there a lot of those companies have been burned in the past. So a lot of them have become much more financially disciplined in terms of reinvestment, which has basically led to a drought in terms of the total supply. So yeah, huge amount of resource bullishness. Yeah, you kind of sidetracked me, but hey, I've been talking about commodities a lot for a reason, and it's because I am pretty bullish on commodities in general. Though, like I said, you do kind of have to narrow in on the specific ones a lot, but commodities in general are massively underinvested. So there's going to be pockets of them that are going to have crazy returns. Though obviously that is a very high risk, high reward environment as well. But yeah, so let's hop back to kind of the topic at hand. Let me think. What was some of the other positions that we changed out of as well? Oh, that's right. Buckle. So I did also get out of my position in Buckle, which was an apparel retailer. For those who were not fully aware, that I'd held for a decent amount of time. You can see I'm still holding Hibbett, which is another apparel retailer, though more of a shoe retailer. And people might ask me why get rid of Buckle. That one I had thought was a relatively high quality company, which is true. In general, I thought of it as a pretty high quality company. Their returns on invested capital were really good. They were well run. They were family run, in fact, and pretty shareholder oriented as a result of that. However, I have been on this channel trying to focus more on more thematic investing, more growth oriented investing, in particular towards like larger markets where there's larger opportunities and things like that. In particular, trying to find good companies that are cheap in terms of their current cash flows, or at least well priced in terms of their current cash flows, with this huge growth potential as kind of like an upside cherry on top, so to speak, for most of my valuations. The point is, Buckle just doesn't really fit into that mode. Not that I'm not willing to invest in those types of companies, but I kind of have bucketed my investments into two different ways based off of that, which relates to the targeting thing we were talking about, because I target different size for my positions based off of these different factors as well. I know I had mentioned that I had changed my allocation system when I was talking about these deviations the other, like a month or two ago, but I didn't ever actually get into the specifics of it. So I'll come over here and show it, because I do on the dashboard have this kind of like overside page where I show the system that I use for determining the allocation system for my investments, or at least an allocation guide, so to speak. But the point is I determine if a company has a moat according to my definition, which might be kind of strict, though people might have very different opinions on what is or is not a moat. But the point is I have some companies that I give a certain extra boost to their allocation based off of if they have a moat, and that also increases how much overvalued I'm willing to hold a company. Same thing for the theme. If a company fits in with a theme I'm interested in, that increases the allocation I'm willing to hold it in terms of, as well as how much overvalued I'm willing to hold it for too. And that relates to these kind of optional upsides and opportunities that I see for some companies. But then I do give some companies a boost if I think there's kind of some short-term timing factors that play into the valuation at certain points in time that might come and go though. And then there's also a manual limit that cuts the allocation by a certain amount if there's excess risks associated with the company for one reason or another. Good examples of this would be companies operating in foreign jurisdictions that I'm not a huge fan of. companies that commodity companies that are in commodity markets, I generally try to give a little bit of a cut to the maximum allocation I'm willing to hold them at, as well as some companies with certain geopolitical or legal risks might get that kind of thing, as well as merger arbitrage plays automatically get a little bit of kind of like a, a risk adjusted measure to the allocation size. But those are just factors that adjust the size. The base size itself is affected by the total value opportunity based off the upside, the total return opportunity based off the cogger, as well as the percentile within the distribution that I have. So the kind of the three valuation metrics that determine how undervalued something is kind of gives a base level for the allocation size. And then, like I said, there's a momentum factor that's layered on top of that. So basically, I kind of have these different factors. It's like value, returns, probability distribution, momentum, but then there's 4 manual factors that includes moats, themes, short-term timing factors, and then long-term risk factors as well. But like I said, it's a little bit subjective, but I've been a little bit more satisfied with this system. I've been using it for a few months now. It doesn't require me to make changes on the regular, which is something I've been trying to fix with my allocation systems. Is something that I'm more satisfied with, but doesn't require me to like change the decision making around it a lot. I can kind of make that decision when I invest in the company or not. This is kind of the results of it. And we've been slowly but surely getting closer and closer to the appropriate allocations. Like we looked like a month ago, there was much larger differences in the size chunks. Though obviously there's large ones over here, but these ones are kind of related to the excess liquidity of my portfolio. I have a huge amount of cash currently, which is related to the fact that I have been depositing significant amounts of capital pretty regularly for the last couple months, as I've been mentioning that was going to be happening, and that will continue to happen for the next like half year to a year or so, pretty regularly. I mean, probably after that. But the point is, I know for a fact how much money is going to be coming into my portfolio on a regular basis over the next 6 to 12 months, and it's pretty significant in terms of percentages of my total portfolio size. So that means it's a lot of capital to put to work. So as a result, there is a decent chunk of it that I have been automatically allocating to the S&P 500 Vanguard ETF. But it should be understood that that's not because I'm super bullish on the S&P 500. I want to make that clear to people. It very much could be sold on a dime if I need that liquidity to buy other positions. And in fact, I also do have short-term kind of market indicators that I pay attention to that might make me even choose to go short the market on certain days, depending on certain dynamics with this position. So the point is don't take this as some sort of bullishness for the S&P 500. This is more of a trading tool and a liquidity tool more than it is a position in the S&P 500 itself. It certainly isn't going to get S&P 500 beta returns. It's going to get more or less than that one way or the other, certainly. So anyway, I kind of ignored the last few comments there, so let me get some of those. Let's see, Scott, you mentioned Schwab. Yeah, we'll mention that one too in a second. I'll catch Jack's comments first. Yeah, Jack, I have held Spirit for some time. I haven't talked about it a lot because as you can see, like I said, it's literally the smallest position I have. Just a couple shares that I grabbed basically as I was kind of curious, and then I kind of immediately decided that I probably didn't grab a great risk adjusted price on it too, which is part of the reason I didn't ever continue to add to it. But I still haven't sold either, since the potential deal is so much further off into the future anyways. And if, I'm kind of hoping for maybe like an interesting earnings or an interesting rumor related to the deal, and it might get an interesting pop, and then maybe I'll be out of it. As you can see, I am down in the position too, so there is that to note. But the point is, it is a pretty huge bankruptcy risk, I think, without the deal. So it's kind of interesting one way or the other. But yeah, last year, there was a point in time where I was honestly probably getting a little too ahead of myself in terms of hopping into arbitrage plays. And so this is now just, I guess you could say, the last holdover from that enthusiasm, so to speak. If you need another deposit, let me know. Do you short SPY rather than reduce and increase SPY? Yeah, no, this is kind of a static position in terms of shares that I'm holding at any given time, though I can increase it if I'm depositing more capital, so the actual size of it changes. But the point is there's a specific amount of shares at any given time that I'm holding long, and I might basically at any given time increase that to 50% more, or back down to the base 100%. And then if the momentum indicators tell me to that I should go for it, then I might go short that whole 100 to 150% for a day or two in the next day or so. It's worth noting I have yet to actually do that short so far, because I did do a live show where I was talking about that momentum strategy that I was kind of developing, though I did do a lot more development since that live stream. So it's worth noting that what you see in that live stream is not the end result. I massively improved it since then. But the point is on average, the momentum indicator only finds like a couple days to short a year. I think it was like once every 4 months or something like that on average over the last 10 years. So the point is it, it might be a while before we actually have one of those days. And sometimes it's literally just like 1 day of shorting and then that's it. So it's a little bit of an, we'll see when it happens. I'll let you know. You in particular, you'll probably hear from me when I do it, because I'll definitely be like, well, we'll see if this works or not. But so far it's just been all along. But it's worth noting that this position is actually isolated within its own portfolio, with only this as well as the bond positions, which it's kind of within its own separate portfolio, and it's leveraged within that portfolio. So technically it's a leveraged position, but the leverage is less than my total cash level. So my overall portfolio is not actually leveraged, but technically speaking, this one position is, which, like I said, I'm not recommending other people to do that, but I like to experiment with things from time to time. So that's what we're doing. And to get to your question, Jack, SPY put over QQ. Yeah. I have SPY put rather than a QQ, which it's a kind of a rolling put strategy that I've been doing and slowly been developing as well, which in some ways is kind of like the other counterbalance to this strategy. It's like I have a kind of a leveraged long momentum strategy with SPY, although I'm using VU for that because of the lower fees. And then SPY puts, I'm using SPY puts because of liquidity reasons and pricing reasons. But I am specifically choosing S&P 500 over the QQQ. And that's partially just because of the strategy that I'm using, and in particular the books and the research that I learned kind of the base bones of the strategy from, and I kind of developed it from, were based off of kind of long-term studies of the S&P 500 over many decades using option pricing and back testing. So the point is the QQQ only goes back so far. I'm sure you could use a similar strategy on the QQQ, but the point is I am technically relying on kind of like a very long-term cyclical pattern to option pricing for this strategy to a certain extent, which it is kind of like a tail hedging type thing. Like these are deep out of the money puts, I would mention, which is why you'll see that pretty much always when I show this, it's like I'm generally down. For example, there was a point in March, when SIVB was happening, when suddenly I actually became net positive on my option position. But then since then, it's been a drain on my portfolio up until really about a month and a half ago. We actually have kind of the overall net loss position from all of the puts I bought over the last year and a half, what has actually increased to we've gained back some of that in the last month and a half or so. But I think that's partially just because I'm improving the strategy. Remains to be seen if that's 100% true. It could just be some short-term fluctuations. But the point is, I do a lot of value oriented positions, but I have been experimenting with learning more about tail hedging as well as certain kind of momentum swing trades. So yeah, I experiment with other strategies, love it or hate it. Nice meta returns, thanks. Yeah, pretty solid on that. It's a comeback down from the kind of the peak levels. We were over 100% on the total return there for a little bit, but came back down a little bit. But that's kind of the beauty of that. We did massively trim the position though, and perhaps a little bit early. In fact, that's kind of one thing interesting to point out is that I actually had some pretty pessimistic numbers on my meta valuation still before or when I was doing the trimming. And then after I did a lot of the trims, I was like, honestly, I probably should have upped the valuation a little bit, because I still kind of had it in like doomsday mode a little bit. So the point is, in the last month, I have kind of upped my actual fair value to it to more like around 276, which is more around where it's currently at. But this is another good example of a company where this one is at fair value. It's high returns on invested capital. It's pretty well run. But it is more of a position where I would say is like it still has some opportunity to the upside. It still has a huge amount of users that we haven't really gotten a whole lot of a monetization out of, that we could get more monetization out of. And frankly, even the users that are monetized still could be more monetized, because it still is generally known as a pretty effective place to do ads and stuff like that. So the point is, I was like, I still look at Meta as being a company that could have significantly more upside, even though yes, it has come up a whole lot more, which is why we didn't cut this one entirely out of position, even though like we did cut the other one. And then likewise, to get to that last one, as Scott had kind of mentioned, yeah, we the last but not least, we got out of Schwab as well. We sold out of Schwab. Schwab was one where we could have held it for a little bit longer, I think, but it also, I think, was more of just like a pricing valuation situation more than it was like a huge opportunity into large upsides. There is some potential large upsides to be gained further, just because of the nature of their business being a small slice, a small cut in terms of the overall pie of which they manage, and then there's market share to be had as well. So there's like still pretty large scale upsides for Schwab, but not necessarily in a industry I'm super bullish about. So once it came up to more around my fair value, as well as reaching a point where I didn't want to add more shares and was too small a position, I was like, fine, we might as well just cut it so that it's not dragging the overall position within our portfolio. So we've added several positions, we've cut several positions, kind of all within a few weeks. Yeah, I'll pretty rapid fire on that one. I see, yeah, a lot of you guys showing up here all at once. Both Jeff and Mr. Beast. Yo, how's it going? How's it going, guys? Sorry if you late the show. Hey, man, no problem about that. Yeah, pretty much just finished discussing most of the details of it. I'm sure maybe you'll watch a little bit of it later, but I mean, long story short is kind of in there in the thumbnail to a certain extent. It's like we added FCX, we ditched Buckle, we cut, or we trimmed some FNF. We didn't cut it all the way from the portfolio, but we did trim some FNF, and I basically trimmed FNF in lieu of trimming FG. It's like FG I didn't want to trim any of. I still think it has way too much upside. Like I was saying, it's over my target, but it's not like some overvalued stock. In fact, I think it's undervalued, if anything. So I decided to trim a little bit of FNF since I thought it was closer to fair value. Then we also added Generac to portfolio, that we had already discussed that a little bit, but we added a little bit more of it. What was, some of the other ones, whatever, you can watch some of that. We gave more of the thoughts, more higher detail to that. Also discussed some of the details related to the trading strategies that we've been developing. Yeah, Mr. Beast, how's it going? Short Apple, you still shorting Apple? How's it going? And PayPal, yeah, we added PayPal to the portfolio. It's already up around 2%, so it's kind of moving quickly. We've been grabbing PayPal pretty much every day, or pretty much every other day. Oh, also Jeff, yeah, one other one we mentioned, we did the swap of Sandfire for Freeport-mcmoran. Finally made that move. I did also add a little bit more InMode this last week as well. I mentioned that. Yeah, so lots of actions in the portfolio. Lots of actions in the portfolio. I'm about to get peer pressure into this again, aren't I? Yeah, dude, FG ridiculous. I cannot believe. Yeah, it's been on a crazy roll, and that's the thing. It's like I was looking at it, I'm just like, man, it definitely feels like it's ready for a pullback or a little bit, but there's just, in my opinion, so much upside potential to it. I've raised my fair value for it several times as it keeps racing up. And I don't think unfairly so. I've done it with the earnings. They report good earnings. I adjust my fair value accordingly. That's how it works when you have a fair value that leaves upside potential, is that you can do that and sleep easy about it. But I still have it at about $32, which is, it's not far from fair value. But the point is I wouldn't really want to be trimming this thing unless I thought it was way overvalued. And that's the thing, is like, how's it going to get way overvalued if I keep raising the fair value whenever it goes up? But like I said, it can go up without me raising it. It depends on how good the earnings are on a regular basis. If it keeps having good earnings quarter after quarter, it's going with the thesis, right? It's like that's how it works. So yeah, you can call me knife catcher for following CVS down. Yeah, that's pretty rough. I wish you the best on that one. I mean, I think CVS is definitely at least the higher quality of the few kind of players in that space, but obviously they kind of they're going through a little bit of a transformation in some ways. So best of luck in some ways on that front. You asked about the basis on Generac. Let's see, where was that? Current basis is 107, 108. And so we're up a little bit, not too much. I got I got in at a 105 and then I got in at 110 and I added around 1.5. And then, I was hoping to get more at 100. But I'm hoping for 90s, man. But I don't know. I don't know if we're gonna get that because it feels like there's all sorts of crazy weather stuff going on, and all sorts of people are reporting on weather stuff too. So it's one of these things where we'll see. We'll see. I mean, I would love to get it down there, but I feel like the world knows that we need some good electrical equipment to help back up the electrical grid. This is the thing. This is one of the things where some of the themes that we've been discussing kind of layer into each other to a certain extent too, because like we talk about the electrify everything theme, and earlier, Jeff, you kind of missed a big copper discussion we had when I was talking about the switch between the copper positions. But so we were talking about the electrify everything theme a bit, but that kind of plays into the weather themes as well, right? Because like there's weather things causing problems for the power grid, but there's also demand increase, right, for the technological changes too. So it's like there's really just this double whammy coming in on the power grid over this next decade, all at the same time, both on the weather front and from the consumer demand front. So it's why Generac, it's like, man, anybody who knows anything about anything, I feel like wouldn't be letting this thing dip. But whatever. I'm not somebody with billions of dollars to allocate capital, so don't ask me, I guess. But yeah, so super bullish on Generac. Definitely not trying to get so bullish though that I average up. We're really only trying to average down on that one, at least for now. If we got our basis closer to 100, maybe we'd allow it to come back up a bit. But yeah, electrification of all plus grid management plus power outages plus with climate change. Yeah, it's like it's just a perfect storm. Excuse the joke there, right? Chart is holding on Generac. We're into Scott. 150 came fast last time. Yeah, he's been messaging me about the Generac charts pretty much every day, and we talk about it all the time. Yeah, it's I'm not a huge chart person, but I listen to my chart people, so that's kind of how it works. Yeah, Generac ATKR is looking pretty good. And then I will say, Jeff, well, we're kind of back onto that topic. Might as well get into something a little bit related to that, which is to say, this week I was working a bit more on the wire Encore valuation. I had done a basic one of that on the potential page, but you can see I have now moved it over to the main page, which means I have completed a main model for it. So we can actually take a look at some of the details of it. I'm kind of considering doing it possibly for the next video. We'll see about that. It's not 100% on that front, because I think Encore Wires are another interesting company to maybe discuss in terms of this same theme, this same discussion. And then you mentioned ATKR, which is why it kind of brought it up in my mind. Because in particular, Encore Wire literally lists ATKR as one of their comparables in their peer group, and ATKR might list the same as well. But the point is, I was working a lot on my model for Encore, which if you look on the valuation, you'll see that it is basically only about fair value where it's currently at. But this is another company that I'm really watching. I'm really trying to see if maybe we get some dips on. One thing, unfortunately, about this is that they didn't really give a huge amount of details related to their units sold, or their unit costs. They only talk about the kind of like changes in their unit prices on a year-over-year basis. So it's a little bit tricky to build up a model for them. In fact, they gave much more information related to their operating costs broken down than they did to like their revenue indicators broken down, which I thought was kind of interesting. Like usually companies give you more information about their revenues than they do about their costs, not the other way around. But the point is, yeah, so I built up a little bit of a model for them based off of a bunch of different kind of market share groupings based off of Aswad-Winteron's electrical equipment grouping, his building materials grouping, also a combining of those two factors. And then there's the peer group that they list within their own company, which includes Patrick Industries, Gibraltar, Nexans, Prismayan, as well as Encore, as well as then some industry research on it. But the point is, working on this one behind the scenes, it still looks only just about fair value, but it's been kind of moving down and up and down a bunch. So the point is, who knows, maybe this one could dip a bit lower and become another good target in terms of that same thematic space. This one much more focused specifically on power wires, copper power wires. copper being like the main input cost for them, which, you know, could put it on an interesting part of owning the entire value chain. Because like, if, you know, I own a copper miner, and then I own a company that buys a bunch of copper and turns it into wires, and then owning also companies like Generac, which exist to back up when the copper wiring fails. You kind of would be at basically all points of the industry at that point. So those last couple comments. Are you dabbling more in AAP or just a small position and intending to keep it that way? I have talked about this one a little bit behind the scenes. It's kind of a little bit of an in-between position, AAP. It is what I'm kind of classifying it as like a value turnaround, in the same sense that as I was talking about with Schwab, that it's not necessarily that I think it has some crazy upside. I was kind of like waiting to see when it gets to fair value. I think AAP is very just flat out undervalued, but they're in kind of like a turnaround position. But the point is, as they perform, as the fundamentals start to come in, if they do actually start to fundamentally turn around and actually show that, then it kind of puts them into a position where they can kind of become more qualitative in my mind, if that makes sense. And I'm allowing for that to be part of the thesis now. Like, that's part of the initial thesis. The point is like, some companies I like I said, is like, I think of more as like quality companies with upside that I want to own for the long term, and then other companies I think of as maybe still quality but not necessarily have as much opportunity, and they're more short-term plays. AAP is kind of in between, where it could be a short-term play. Like, if it just ran up 50% in the next 3 months, and we didn't get any real fundamental turnaround, I would probably sell out of AAP. But if it didn't go 50% in the next 3 months, if it only went 20% in the next 3 months, and we got some actual fundamental improvement in the next few quarters, maybe by the next 10K, they actually report some market share gains, then and maybe even some margin gains as well, and that 20% is justified, well, then at that point, I wouldn't necessarily want to sell out of them. In fact, at that point, I would maybe be improving my valuation for them, like I was just talking about I do with FG, right? It puts them in a position where they could have their valuation improved based off of the fundamental factors, which, by the way, like I said, is like, this is kind of the framework in which I'm trying to get more of my positions around. This is kind of the new kind of approach, where it's like, I try to have valuations that I can very, very easily improve my own assumptions on them without it being a huge, bullish case that I'm suddenly jumping up to. I'm jumping from like a slightly pessimistic case to a less pessimistic case, and then they improve fundamentally, and then we improve to a less pessimistic case, and then less pessimistic, and it pushes the valuation upward, but based off of the improvement of the fundamentals. And then that allows me to decide if I want to continue to allow the position to run, or if to start to trim off of it. So AAP is kind of in a position where it could kind of be in either camp, because I do have a kind of a long-term thesis, like I talk about in the video. It's like, I think there's a huge amount of a backlog in terms of the auto repair that's needed, and I don't think that the auto repair industry is going anywhere over the next decade. But the point is how bullish I am on AAP in particular kind of depends on the next year of their performance. So we'll see how it actually goes for them in particular, how long we actually hold them for. Oh, how's the PayPal video viewership? Doing pretty good initially. I mean, it was doing amazing off those first couple of days. I usually post my videos on Friday, and you may have noticed that it came out on Wednesday. And that partially has to do with the fact that PayPal had dropped 6% the day prior to that. And we literally just had videos on PayPal from some of the largest finance YouTubers literally just in the 2 days prior to that as well. And then there was other videos that came out after my video as well. So the point is, it just seemed like it was the PayPal week. And since PayPal had dropped 6% the day before, I was like, time to drop it. But over 250 views currently in 4 days. That's pretty solid for us. You can see here over the course of a few weeks, we usually generally only expect to get a few hundred, but I would say it slowed down in the last day or two. So it's like most of that came in the first 2 days. And so that, which is true of most of the videos. So it's one of these things where it's hard to compare ones back here to ones right here based off of not knowing how the slowdown effect is going to go. But it has gotten a lot of likes as well. I will say that it's gotten kind of a disproportionately large amount of likes. So people seem to like it. So we'll see how it goes from there. But yeah, it was the week of PayPal videos. So It was definitely the right time to be dropping it. The new CEO as well, I think, is a pretty good catalyst. We'll see how well it goes. As I kind of mentioned in my video, I kind of interjected about the CEO a little bit. He is untried in the CEO position, so it might be a quarter or two of the market kind of learning how much they like him or not. But as we talked about, it's like we think most of the risks have been shaken off, especially considering the scalability of their business, which is again part of why we're more bullish on it. We're trying to look for these companies that have these larger scalable upsides. Would love a double on AAP and roll into that quality Ulta. Yeah, we got some people in the Discord very much talking about Ulta a bit more lately. I haven't been focused too much on Ulta, but I did do a basic kind of overview look at Ulta at some point several months ago when I was looking for valuations to do, and it found it to be overvalued, though it's just kind of on my basic page, so the assumptions I put in there are very arguable. And I can't really remember what like terminal multiple assumptions I even attached to it necessarily. But it is a very high quality company. I've always been very interested in trying to maybe find something in the makeup space, though everything always just seems to be well priced within that space, but a very high quality company that I don't think is going anywhere. But at some point or another, we might get more interested and might start to take a look at it again. But yeah, some people in the Discord in the chat right now are relatively bullish on the company, at least in terms of liking it. No, not necessarily overly bullish on the stock. Other companies also, I will say, we added some more companies to the basic page as well. So ones that might get models at some point in the near future. One thing we did talk about Ugrow a little bit last time we had a live show, but I did also recently add Movado Group here. This was one that was suggested to me by Jax. I don't know if he's still in the chat right now, but me and him were talking a little bit behind the scenes about this one, which this company seems like it has some interesting potential to it. Definitely. This one being a kind of luxury retailer and licensor. Definitely very interesting company. Very relatively select amount of overall exposure. Like I said, luxury kind of area, but specialty retailer apparel. Like I said, I haven't looked super closely at it in terms of like taking a look at its overall stores and units and stuff like that. It's just some basic assumptions I threw in there, but it did look kind of interesting potentially. Just lacking a catalyst. Yeah, perhaps. I mean, like I said, it was one that was kind of just suggested towards me. I think they found it probably based off of like filters and stuff, and screens. If I had to guess, I'm not 100% sure. But the point is, yeah. So I think it was just like, definitely looks like a potentially decently quality financials that looks cheap, and I generally agree. But yeah, maybe not a catalyst or something like that. I definitely don't always invest in things with catalysts, but it is important to kind of try to have them. I happen to have collected fine watches a while ago. I don't see the greatness MOV added. Fair enough. Like I said, it's like luxury items have had kind of like a crazy time over the last decade. I know I've seen like a lot of interesting data surrounding kind of the luxury space in general, discretionary spending. So it's like it's pretty arguable that can continue even regardless of some of the other kind of economic conditions I've made people discuss about. So I don't know. It could be interesting. Seiko. Yeah. Also, I will say I've been looking a lot more closer at ICL as well. That's another one that has been up here for some time, but it was one that I've been kind of curious and maybe interested to build a model for. I haven't really built out a full model for it, but I was really reading their annual report in depth, and unfortunately, it's just an incredibly detailed, in-depth annual report because they do agricultural inputs, but they do a variety of agricultural inputs, a variety of fertilizers and other chemicals and base materials and stuff like that, and they really break it down into fine detail. So honestly, it's a very complicated one to try to get my head around, even though, as I've kind of talked about before a little bit, it seems to me to be the only one of the kind of like fertilizers or other agricultural input companies that is reasonably cheap. I've looked at a few of them. For example, we have Mosaic here on the dashboard as well that just doesn't seem to be as cheap. But ICL is the one that seems cheaper to me, so I've been kind of looking at it, but it might be because it's complicated that people don't want to invest in it. I could definitely understand that, though sometimes that makes the juice worth the squeeze. But agricultural inputs and fertilizers is another commodity that I am somewhat more bullish on, even though I don't really have price predictions for those particular commodities, but they are heavily correlative with energy commodities. You can usually find that agricultural commodities are highly correlative with energy commodities, oil in particular. So you can kind of use those as a proxy a little bit, I generally find. But the point is, agricultural inputs are other things that are going to be very, very sensitive to weather disruptions, not just weather disruptions, but also geopolitical disruptions. If you go and take a look and find out, you'll find that a lot of fertilizers come from places like Russia and the Ukraine. In particular, potash fertilizers, those are the two biggest sources of them globally. And there's like kind of, if you understand fertilizers, there's kind of like basically three major categories of fertilizers, all of which are necessary for modern farming. And the most sensitive and like the least paid attention to of those categories tends to be the potash category. So that's one of the reasons that I've kind of, for kind of understanding these kind of macro dynamics, is one of the reasons I've kind of been very bullish on that industry in general. Though I think this is knowledge that most people understand and know about. So it's one thing that to be understood about a lot of these themes is that this isn't just because you know this doesn't mean everybody else doesn't know this, right? So one thing about that is that when you look at these themes, you look at copper companies, you look at electrical equipment companies, you look at agricultural input companies, you'll generally find that a lot of them are already well priced, and that's because everybody already knows this information. The Generac, right? We were talking about Generac not going down because everybody knows these things. But yeah, so interesting to pay attention to. You guys were still talking about watches there for a little bit of a minute. Let's see. They own almost everything. The ETA movement. It might is TH on your list that you got from the chat logs. TH. I don't think I wrote that down at any point. I might have kind of just skipped over it at one point. There's some ridiculously cheap South American, Argentinian fertilizer companies out there. I'm too scared and don't know enough about that place to take the risk. Yeah, I was going to immediately make a point about geopolitical risks. That's always one of the tricky things when it comes to commodity companies, is that you know, when you're investing in a commodity company, you kind of have to be careful about what it is that you're investing in. And I mean that in just like a type of investment in a sense, not even just like the actual risk itself. Is but a commodity company might be priced cheaply because of the commodity price. It might be priced cheaply because of the location of the assets, the geopolitical risks, and it might be priced that way because of the actual operational speculation of the management themselves, right? They might be doing like some exploration of some sort in that natural resource. So when it comes to like commodity companies in general, you always kind of have to pay attention to like, what is the thing that's going to make this move more? What's more relevant to the price movement of this stock in particular? Which is one of the reasons, like I was saying before, I switched from Sandfire to FCX. That Sandfire, while they are related to copper because they're a commodity company, they're also doing some development of their mines themselves. So some of the price action is more related to that operational success, whereas FCX is more diversified across lots of assets, and they're in safer locations, which means that more of their price action is going to be based off of copper specifically. There's going to be less price action, but it's going to be much more directly related to the factor you're trying to get your exposure to. So that concept is generally true of all commodity companies. So yeah, if you're going to look at some small fertilizer companies in Argentina, then you might want to be careful about that, because that cheapness might be more about the fact that they're Argentinian than the fact that they're a fertilizer company, right? One thing I'll point about ICL is that this is an Israeli company. Likewise with another cheap Israeli company that I've been very, very fond of, that being like InMode. So it's one of these things where, yeah, you might want to be careful about when you invest in something like this, because the reason it seems to be a decent opportunity may not necessarily be because of the agricultural inputs. And also, like, for example, they have some relations with some production facilities in China. So that's part of the cheapness there too, though it's not a huge portion of their business, which is one of the reasons I'm still looking at them. But yeah, compare this, for example, ICL to, like I was saying before, Mosaic, which Mosaic operates. I think they have assets overseas. I think they have some assets in like Australia, some ones in Asia as well. But I think the majority of their assets are actually still in Canada. And so then look at that, they're not very cheap. So it's like interesting how that works out. The one that has a lot less risks suddenly isn't as cheap. And it's like, yeah, well, that makes perfect sense. Nice choices on the watches. Still talking watches, man. I gotta get me a nice watch. I've never really been a big watch person. I'm not gonna lie. I've never really been a big fan of too much ornamentation in general. Other than sunglasses, I like having a nice pair of sunglasses, but other than that, it's like kind of no rings, no watches, no necklaces, none of that stuff. Trying to bully Jeff into joining the Discord. It would be nice to have him there, but hey man, if he's not the type of person to use it, it's not the type of person to use it, you know. Um, so what else do you guys want to talk about? You guys want to take a look at a company or something? I can kind of mention what we're expecting this week. There's not too much in terms of economic stuff going on this week. We're gonna have what was it on Thursday? There's the wasn't it inflation expectations? I think we were gonna get. Oh, that's on Friday. Inflation expectations, and then Powell's gonna speak on Friday. That might be the most exciting thing this week, other than like the oil stocks, which is always like every week. That's not really necessarily something different, but it's been kind of a hot item lately, the oil stocks. So I would say that maybe pay attention to that. That's always on Wednesday, by the way. The EIA oil stock numbers come out every Wednesday. But that has been a little bit more of a hot ticket thing to pay attention to lately because of the oil action, which let's retrace back down a little bit from some of the action. But you know, everyone was paying attention to oil when this was happening, right? Which is why I had to start paying attention to oil too, I guess. But TH, yeah, so let's talk about TH. You mentioned that. Was Hell's Resorts Cruise Lines? Oh yeah, good point. Good point. They own detention centers for migrants, kind of a sad space, but oh, that's right. Yeah, I remember you mentioning this one before now. Yeah, but they actually serve the food at these centers. Yeah, you were saying it's like this is like actually like one of the nicer ones though. So it's like, hey, which you know might put them in a good position. They got removed from RTK and fell with the SPAC craze. They've done well for me. That's right. I remember you vaguely mentioning this one now. I didn't remember the ticker, but yeah, I remember you talking about a somewhat higher quality migrant centers. Yeah, the SPAC craze. Yeah. Take a look at valuation a little bit. Yeah, of course I gotta get an identifier. It's just not always on. Sometimes I turn it off and switch it out because you know you can only have like the three. So sometimes I'll switch it out for the VWAP thing or whatever. But I pay attention to them. But anyway, coming over to ticker. Man, so they've been trading super low single digits for the last year, and then prior to that they were kind of in some sort of more typical range. Well, not super typical. They had a kind of maybe semi-normal EV to EBIT, but then their EPS, their gap EPS, was basically riding off of an assumption that those earnings are coming back. So they flipped from kind of low profitability with the assumptions that the earnings are coming back to a high profitability with the assumption that the earnings are going to drop off, which you know is like a lot of companies lately. But that's interesting. Let's come over to the estimates and see how that fits in. 10% of revenue growth is generally expected this year. I don't know how well they've been matching that, but we'll assume that they are. Down 19% the next year after that. And we're assuming about a kind of 10 to 12% drop in the EBIT margins, but from pretty pretty high levels to still high levels though, relative to at least these last couple of years of assumptions. But let's actually see what the ratios were for long run, which we only really got back to 2016 as we were talking about. But prior to 2020, they were kind of averaging 25 or so, maybe 25 to 30. So going back down, as we were kind of saying that they're going to go back down, that looks like they're not really going back down in a bad way. They're kind of going back down to more normal. And also, you were talking about how do, I'd be curious to see the nature of this. Like, is this, is it, is this all just done through like rental and then there's other companies that are renting it through them, or are they actually like owning and operating directly? That's one of the things I'd be kind of curious about. Like, hospitality facility services owns a network of specialty rental accommodation units, and then, so like it calls it rental accommodation units, but I'm wondering how much of the property capital that they are specifically taking that risk on themselves, or if it's more of an operation. Company provides catering and food. They own properties and license the prison-like facilities. Yeah, see, that's kind of what I was wondering. I was like, is this like kind of like a REIT type scenario, even if they're not actually a REIT? Is it still like kind of that vague setup? Hold on just one second. Just let my cat out of my room. He's being a pain in the ass. But yeah, so okay, so yeah, if I'm, because that's one thing I was kind of wondering about in terms of their margins, because if because we're looking at those margins, and I was saying that it's not that crazy to assume they're coming back down to 32% of EBIT margins next year, because that's going to include the depreciation and amortization costs, which means I would still sort of expect it to normalize back out. So like this decline in margins, I'm not necessarily concerned with. I'd be curious to see like why we have this run up and then this drop off like this, but that might just be kind of like a normalization of it. I'd have to kind of see what's really going on there, but it kind of makes me feel like less concerned about this revenue decline and this margin decline, if that's really how their operations are. It might just be kind of like normalizing off of this growth, because when real estate tends to grow really fast, there tends to be a lot of kind of weird accounting for a year or two while the depreciation and amortization is basically catching up. It's usually kind of throws things off a little bit, which is true for REITs too, which is one of the things I tell people to be very like wary about what they think like typical REITs multiples are, because like it's like, well, which multiple are we talking about? Because if that includes depreciation and amortization, it might have some weird stuff going on in it. Yeah, so it's like one of those things where you kind of have to take that into account. So yeah, the point is, yeah, I don't know, maybe they may not be doing that bad at all based off of that factor. And then yeah, going from revenues, just click on the total revenues, like yeah, that's pretty fast growth in the total revenues. So it's like we're expecting a bit of a drop off, but that's not going to be like it could be a bit of more of a normalization of sorts, so to speak. We'll come over to the balance sheet. We'll take a look at that. Where are these? Yeah, 665 million in assets, 420 of it being net property, where it's actually about 800 in property. So yeah, lots of depreciation. 800 million in gross property versus 600 million in gross revenues. So yeah, pretty significant amount of overall capital that basically means. And then not too much debt. It's mostly just some current debt, which is interesting. That they didn't roll over their debt, or it's not being or as such. They're basically choosing to pay off their debt this year, it looks like, or either that or they just haven't financed it yet. Maybe they'll start to finance it at some point over in the year. Maybe if I come over to the cash flow statement, maybe no, that's being repaid. I haven't rolled it over, so deleveraging a bit, sounds like. Let's look at the actual overall ratio. Yep, deleveraging. Oh, it's not showing the last point here. Well, it's only coming to 2022 right here, but in the last trailing 12 months, it's back down to 56%. So yeah, pretty decent deleveraging relative to the fact that they were growing a lot. That puts them in a pretty good position. So I mean, yeah, they're looking for potentially like they're in a pretty good spot. I'd be curious how much of a further opportunity they have. That's definitely one question to maybe have. It's like they were growing a lot here in these last couple of years, obviously for reasons. How much of that growth is likely to continue into the future? If they have even moderately considerate growth forward, just at least not declines, you know, then they could possibly be a pretty good value. Especially considering that they were at kind of depressed prices. Those depressed prices and multiples kind of seem to assume that we're going to have a huge drop off in earnings, as we were talking about, but the earnings seems more than kind of run up against it. So yeah, interesting. If we have more flooding, more first responder events where they can set up government paid for temporary locations, it could be a climate change theme too. That's an interesting, another interesting corner, another way to think about it. Sure. I can get behind that. That's not one that I would necessarily be super hyped on, because obviously it kind of is a little bit, feels like a little bit more derivative. You know, it's a little bit more down the line in terms of getting it to be as a climate change effect. Because like there's gonna be lots of climate change effects, but like whether or not, that kind of depends on like where the flooding is, I think. Right? Because like that may not matter as much if the flooding isn't happening where the migrants are. I don't know. Maybe I'm thinking about that wrong. I'm not sure. But another one we want to look at. Did you mention SWBI? Did we want to talk about SWBI? We can talk about that a little bit more. Multiple operations, one for migrants, one for first responders. Oh, okay, interesting. Yeah, I mean, maybe I'll take a look at it. Maybe. One thing I was gonna I was kind of curious to kind of take a look at again, not because I'm even necessarily super interested in it, but yeah, check SWBI first. Well, I mean, me and him have definitely talked about some SWBI, so I'm not sure how much he's asking for himself or just kind of asking in general. But I mean, we still can. But I will say it's like, you know, this one right here, Curate Retail, that I covered a long while ago, is one that has continued to be asked of me to cover again by many people. Some people who I don't care too much about covering things for them, but some people who have contributed you know, useful information to the channel and really supported me and stuff like that. So some people who I like to please and try to do valuations for have asked about this one too. So it's one of these ones where I'm not that interested in looking at it again, but at the same time, I kind of want to look at it again for people who've asked for it. No, we don't know each other IRL. He's basically, I would say, probably been one of the most supportive of the people, of viewers on the channel, in terms of like actually kind of helping keep the channel developing behind the scenes. In fact, I would say you can kind of thank, I mean, obviously you're not part of the Discord, but anybody who's part of the Discord can kind of thank him for the Discord actually being an active place in the first place, because I had made a Discord, but I wasn't really using it very much. It was kind of a very dead, empty place prior to him kind of pushing me to do so. So we chat a lot kind of regularly within the Discord. So we don't know each other IRL, but out of all the viewers, I probably have talked to him behind the scenes the most. So that's just yeah, he's a big OG in that sense. You know, it's like there are some other viewers that have maybe been around a little bit longer than him, but he's definitely really put his 2 cents forward and really contributed in many other ways, more so than the vast majority of you. Step up, some of you. I guess I should say. I'm kidding, of course. But yeah, so yeah, Curate, which I can see is now Liberty Interactive Corporation, which is kind of funny. I didn't even know that ordeal had happened, but I guess that shouldn't be too much of a surprise. My guilt. Hey, you have also been an incredible contributor in your own different way, Jeff, because like you have been much more regularly present at all of the live streams than even he has. So you know, you're actually even more supportive in a different way. So you know, that's kind of the thing about, let's say, a lot of you guys is like there's some of you that kind of fit different pockets. You know, each of you kind of fit different roles of support, I would say, in some ways. So yeah, I much appreciate you always being here for the lives as much as you are. Obviously, you're not here every time. You don't have to be here every time, but the point is you're here. You're here more than most. So that is in its own way a different type of support that is highly appreciated. But yeah, so looking at this one though, man, this is crazy. I can't remember exactly where it was when I covered it. I can't even really remember, and it might have been like split or something adjusted. I'm not even sure what happened actually with this. Like I said, like I haven't been paying attention to this basically since I did it. And it looks like Ticker still has it listed here as Q rate retail, which is interesting. Yeah, I wonder. Oh wait. My oh no, that's the BMV there. So yeah, that's interesting. Obviously, there was all sorts of weird reorganizations going on with the Liberty Media Group, so it's not entirely too surprising that they had done some sort of reorganization related to this. But yeah, I was like, people were asking me, like I said, literally just this week about this one again, and I was like, oh well, maybe I'll take a look at it again. But I didn't realize it was basically probably going to be an entirely different story at this point. So I don't know, maybe not take a look at it, but it is a penny stock these days. Looks like it's trading at some sort of semi-typical-ish range. Choir's podcast had a guest 2 weeks ago pitching Madison Square Garden Group as well as Liberty Media, saying sports franchises are worth double what their market cap suggests. Yeah, I think I've heard some people definitely talking about sports franchises being a bit underpriced in that sense, and I hadn't looked. I've seen Madison Square Gardens come across in screens various points over the last year or two. It's always been one of the ones that I've kind of just passed up because it felt like it would be, I don't know, it just felt like definitely an industry I had a lot of uncertainty around. But yeah, maybe everybody has that uncertainty. So maybe there's some real opportunity there. And it's definitely one where, yeah, I've seen it appear in a lot of value investors reports, particularly the type of people who do a lot of asset plays, which is another place where you would find this, yeah, the Q rates, as well as the Garrett motions, the GTXs. That's another one that was popping up. People were messaging me about when all the 13Fs dropped this week, and everybody was talking about what was in Seth Klarman or other asset player investors, Howard Marks and the like. Yeah, so I don't know. Like I said, like it seems like this one has literally changed into a different structure entirely since I last looked at it. So it's like, yeah, I feel like I would have to really go read their 10K to even have an idea of what's going on here. What is MSGS looking like? MODG. MODG. Wow. Madison Square Gardens is trading at a high multiple. Must be on asset basis. Top Golf. Yeah, this one was well, either Top Golf or Callaway. Was that either of which was pretty popular for a while there prior to the combination? Jeez. What happened here? Yeah, it's been pretty popular in ARM value investing. No, not surprised, I guess. See what the multiples were kind of like a little bit before. Averaging like 18 forward EBIT, 28 forward PE. Obviously, kind of some elevated levels over there, but 24, 16, 24. Higher interest rates now, of course. So it's definitely getting cheaper. It doesn't look like it's getting that much cheaper necessarily. Still looks like it's pricing in a decent amount of growth, which I expect people are, yeah, probably assuming. Lots of analysts assuming 10% next year, with it confirming for this year. So I mean, solid growth, nothing extreme though. So the question is that those type of numbers lasting for a decade? Because if so, then it looks probably pretty good. But I wouldn't say it looks, you know, it ain't no PayPal. That's all I'm saying. It ain't no PayPal. In terms of doggedness, I'm talking, of course. Obviously, it's a very different company. And before somebody accuses me of comparing PayPal to the Meta situation, like, yeah, we're comparing doggedness, comparing the doggedness. He's looking to get hurt again. Hey man, just don't blame me. You know, I'm not a financial advisor. This is not financial advice, all that jazz. I'm managing my own portfolio, yada yada yada. Yeah, yeah. Yeah, I mean, definitely going to pay attention to this one maybe though. It's definitely getting closer. I'll say that. It's definitely getting closer. Down. We're now down to where it was in like the 2019, 2018. We're around where it was when I started investing. So about that. So not terrible, definitely. What else? Any other ones you guys want me to look at real quick? For other ideas? I've been still keeping an eye on Parix. I'll say that. Obviously, I made the video on BTE, but then that one, as I was saying, it kind of ran away from me. But Parix has been dwindling downward, but this one has geopolitical risks associated with it. I'll say pretty much all of their assets, other than their corporate headquarters, is in Colombia. But that's oil and natural gas and stuff. So I don't know if that one comes. I'm trying to get a higher expected return on that one as a result of the fact that it's in Colombia. But I'm watching that one. Keep an eye on that one. We're watching LPX. I'm trying to kind of refine some of my assumptions around it because I did up my valuation for LPX recently when I upped my expectations around lumber prices. So inherently that meant I upped my revenue assumptions for LPX, but I've been kind of trying to double take on that one and make 100% sure that makes sense. Because it made it jump up by so much that it makes me feel like maybe I'm getting something wrong there. And I kind of wanted to double check on that. But the point is I still haven't taken a position in it, but I kind of want to. But yeah, I'm trying to be careful about it since I already have my Inter4 position, but I am just very bullish on lumber. That's true. Even though, yeah, it may not be for some time. I don't know. I don't know when we're going to get that moment for lumber, but I think we're going to get that moment eventually. Like I said, I'm looking at wire, Encore, that is. I am still kind of curious about this Ugrow one. I'm still going to keep an eye on it. I do think it's very, very interesting. This didn't pop up, but do it. Wait, which didn't pop up? I'm confused. Yeah, urban grow though, I'll say I'm gonna keep an eye on this one. What I'm kind of like thinking is that I kind of want to like pay attention to this one and just like watch it and then see if, can you see the message above to like? No. It's like I see it says Midas the financial investor, then ha ha ha, and then the arrows, this didn't pop up. know that they've been kind of adding some features in some of the live streams, though. I've heard some other shows that I watch were like talking about, I think there was like some likable, like the people holding the streams had the ability to like or heart certain chats or something, or maybe it was only super chats that you can do that for, which I can't do super chats yet, hopefully soon. But yes, I think they've been maybe playing with some of the settings a bit on some stuff. Yeah, like the stream, guys. I mean, I appreciate we already got some likes on there. I don't know how many of the people who are watching right now haven't already liked. It might be that you all have already done it. Well, we got the restream thing about 100 messages though. But yeah, if you're watching live or on the replay, please like the stream. Please subscribe to the channel if you're not already. Please make sure you hit that notification bell. If you haven't watched my PayPal video, go check out that PayPal video. Like that as well. Share that. Share this stream. Make sure you join the free Discord. Link is in the description below or the pinned comment in the chat. All of those things. Make sure you try to do all those things if you can. All those things will make sure you get access to pretty much all the content we produce. You have access to, you know, messaging me and asking me questions on a regular, like various people in the Discord tend to, as well as it lets you know when I'm going to go live or have other things like that. Yeah, make sure you all do all those things. Yeah, Jeff personally horsepowered us to 100 messages. Yeah, I mean, for real, if we were to make a distribution by viewer of the amount of messages, I'm sure the Pareto distribution is going to apply to you pretty strongly. You're probably at least 20% of all of the messages that have been sent in chat, if not maybe closer to 50. I wouldn't be surprised, honestly. It's like you and Mr. Beast, probably, are some of the bigger ones. Because like Mr. Beast, he was watching me relatively early on. Definitely. Like he's kind of like come and goes depending on which day, how much he's there or not. But I remember him showing up relatively early in the live streaming process. That's for sure. It's all that lack of Discord. I have to hold it in all week to let it out on Sundays. Yeah, exactly. It's like you got the one day of the week that you can talk to me much more directly, I suppose. That works. That's true. As I was saying, Scott, he's not necessarily always here live, and it's like that's because he's talking to me in the Discord every other day or something like that. Yeah, so we'll see what the next video is. Obviously, it's we got the PayPal video out last week, so it's on a kind of a 2-week schedule, but I was trying to get that video done and edited and out kind of like well ahead of time so that I could kind of make sure and work on other models ahead of time. I've been trying to get ahead. I've been trying to get a little bit ahead of my schedule. That's kind of been a goal of mine, is to get to a point where it's like I sort of have a video, or I have a model fully done and ready, and a video basically ready like about as one ahead of time, so that I'm a little bit less stressed in terms of my school schedule, which is worth doing because like my school semester did start last week. So the point is I'm trying to get ahead, and with the PayPal video I managed to get mostly ahead. I didn't quite get it to like one full head, but I was basically about done with one other model when that video came out, which the model being, as I was talking about, I had been working on the Encore model, and then I've kind of been side working on the development of the ICL model, although it's only just the bare bones of that one that I put together so far. But between those two, the point is one of those two I think is likely to be the next valuation that I do. 2 weeks being from now that is. But the goal is that hopefully by the time that video comes out, I will not only have that video coming out, but I'll already have another video already done, already edited, and basically just kind of ready to go. The tricky part, I'll say though, with that is that trying to make valuations and then get them done and edited ahead of time, it's like that's not easy for valuation content, because I like when the valuation's done, I kind of want to get it out immediately, because it's usually as of that moment. Like all of my information is as of that moment, right? If I wait a week, then I am often in this position where it's like, well, maybe some slight thing I was thinking changes or something, which of course, obviously you don't want your valuation to change massively week to week. That's not really how valuation is supposed to work. But the point is nonetheless, the little details of your thinking can change all the time about little things. And so I try to kind of like put a stamp on my thinking about evaluation and then just put it out there, and then not necessarily think about it too much after that, unless there's something major that develops. So it's like, it might work better for some companies. Like I think what my strategy is going to do is like, maybe I'll try to like have a less popular company like a company that's going to maybe get less views, like maybe a Baytex Energy, I'll try to have that one kind of prepared ahead of time and locked and loaded. But then maybe companies like PayPal, where it's a little bit more timely, it's a little bit more about like the views or about the kind of the sentiment at that moment in time, then maybe I'll try to drop these ones a little bit more immediately and then try to have one in the chamber, so to speak, ready for that. But obviously it's very, I'm talking kind of strategic about the valuations I do and the videos that get made out of them. So it's like, I don't know, if I was to complete both Encore wire and ICL, if I was complete both of those models, maybe I could put the more popular of the two, maybe Encore, out first, and then just kind of sit on the ICL one, waiting for a day where one doesn't sit there or something like that. Yeah, valuation's best in the moment. Yeah, it's always as of that moment in time. It's like it's always with the given knowledge as of this moment in time. So if you wait one more day, you might have more knowledge, right? And so therefore things might change. It's always part of the trick there. Mr. Beast, say my name. Say my name. Yeah. He heard, he was summoned. But yeah, we were saying it's like you've been around. You've been an OG. You might be quiet in the background for a lot of times some days, other than asking for us the short apple, but you back there. OG. But yeah, so I think that's basically gonna do it for today. I appreciate you guys being out here and chatting, in particular Jeff, obviously, always here chatting a lot. Mr. Beast, appreciate you too, of course. Appreciate the likes you guys got. I'll ask one more time, like the stream if you're watching on the replay. Subscribe to the channel if you're not already. Hit the notification bell. Join the Discord if you haven't already. Check out the PayPal video. I know I say all these things already. If for some reason you feel like it is your obligation or your desire to support the channel, there's also PayPal links and other support links in the description below that you could do as well. At some point or another, we might create some sort of situation where people can request to have certain companies be analyzed in exchange for such things. But you know, in the meantime, if you feel so, you can also support me. People tell me I should be trying to push that here at the end of my streams as well. So I'll catch you all next week on the next live valuation. In 2 weeks, we'll be having another valuation video. As I said, I'm not 100% sure which one it's going to be, but probably going to be between ICL and wire. But I'll probably be able to tell you which one is going to be next week in the next live. So I'll catch you all next week.